Welcome everyone. To those who just joined, on behalf of the Greenleaf team, we welcome you to Greenleaf Connect. I'm Dominique. We have Josh and Dave here, and we also have Natalie. We're going to kick off the multifamily sector of the business here and really answer any and all questions that our partnership has regarding the last quarter or overall strategy moving forward. Without further ado, Josh and Dave, I will pass it over to you.
All right. Thank you very much, Dominique. Welcome, everyone. Thanks for taking some time today to listen to what we have to say on our residential portfolio and how things are going. To start with, the first quarter was exciting that we sold 3 deals. Sold Heritage, we sold Hillcrest, and we sold Oak Hollow. So 3 very good sales. Heritage was the fastest deal we had ever done, from purchase, renovation, lease up, sell. All of that was the fastest we had ever done anything. So that was pretty exciting. That was part of the QOZ fund as well. And the other 2, Oak Hollow was a Foxwood.
Yeah, it was a Foxwood 1031 that, I mean, Foxwood, for those of you who were with us then.
They're still with us now.
Yeah,
Oak Hollow.
Exactly. So 2012, we bought 106 units, multifamily. We bought it for $25,000 a unit. It was a Fannie Mae foreclosure. And half the units were either broken into or flooded, or it was a disaster of a property.
It was exciting.
And then fast forward to probably 3 years ago, maybe 4 years ago, we sold it for a little bit over $100,000 a unit, and rolled our 1031 exchanges into Oak Hollow. Yeah. And now we're on Gen 3.
Yep. This is a 1031 that now our basis is getting negative. So very good tax advantage strategy, obviously in the real estate world. So that has been very positive. And then Hillcrest is another sale that we're doing a 1031 with. And we purchased that one. That was our number 17 deal. So we've owned that one for quite a long time as well. We were sad to see Hillcrest go, but it was very profitable, and we're excited about the new things to come with it.
That was our first property in South Carolina.
That was, yeah, Spartanburg, South Carolina. So that was a good deal.
Yes.
So those 3 exiting, we're at a point now with our portfolio where all of our residential assets are essentially stable. And that's the first time we've ever had that. So a lot of effort on the residential team this quarter was spent unloading those 3 assets. And now we have really a fully stable portfolio that we have not seen in 8 or 9 years here. We've always had some form of major renovation going on, and we don't have that right now. So it's a little bit of a breather moment, but on the same side, that's really honing in on operations and improving the efficiency of what the business is doing. So we're going to touch point on a couple things that are leading the residential segment, and then we're going to go into different deals and answer any questions that you may have. So the first part that we want to touch base on is retention. So we're always driven by retention. That's been our strategy for, almost 10 years now, that we're going to lead with retention. And 2020, we were pretty nervous on retention, and we haven't seen it rebound to the 2019 and prior levels. We're always in the, prior to that, our goal was 70% retention, and we saw a lot of 50% retention months. The first quarter, though, we were at 75% retention across the board. So that was strong, but what that also led to then was our revenues did not grow as much as they had in previous quarters. So anytime we have rising retention, we're going to then see lower revenues. Just how it works. If we have half the units turn over, then we can go get higher market rents. So.
Right. The typical renewal, we're usually increasing by maybe 2 or 3% on the high end, maybe 5%, versus a new lease. We basically go in, we remodel the unit, and we basically go all the way up to market to go after the top dollars.
And our revenue strategy in the past had always been based on, if retention is 70%, if it was higher than that, we felt we could raise rates. And if it was lower than that, we're like, we probably have to lower our rates so we can maintain occupancy. Coming out of, the period from 2010 to 2018, really occupancy is what dominated the landscape on multifamily strategy. Was how do you make sure that you're occupied? And we had used that retention number to say, if we're above that, we can raise rates. If we're below that, we should probably lower them to maintain occupancy. We've kind of thrown that out the window. When 2020 happened, we essentially went to like a no, don't raise any prices. and leave them where they are in a hope that we can get everyone to stay. And then shortly thereafter, that switched and we started seeing really dramatic increases in rents. And now we're at a standpoint of on any renewal or any new lease, let's go see what the maximum is that we can get in the marketplace to really capture the revenue, because that revenue is needed due to taxes and insurance increases that we've seen. So some of these came through on reports. You saw that our taxes in some cases doubled on properties, or insurance rates doubled. There's lots of things that lead to that. It's not just what we're doing. It's a lot more macro driven than our little submarket. So property taxes specifically, I think we started talking about that in 2020.
Right.
They're just going to have to, they're going to have to go up.
The cities, have to afford their payroll. They have to afford everything they're doing. So that's the only way they get revenue.
Yeah.
Primary, right?
Yeah. And sales, I think there was uncertainty with sales tax. Obviously, economy's kind of gone gangbusters, but people are buying anything that's not bolted down. Property tax is still going up. So we want to just touch base real quick. Our property tax strategy, when we buy a deal, it's coming with, these are the property taxes. That's always reassessed to what we buy it at.
Right. Yeah. So if we buy a deal, and let's say the property taxes are $50,000 a year. We reassess the second year to basically be reset to our purchase price value. And that might be $100,000. And then really from a modeling standpoint, we put basically a 3% escalator in there for every year, but really it depends on what the market's doing, what the other surrounding properties are selling for, and how aggressive the cities and municipalities want to get with us. As a result of that, we hire tax appealers to go and fight those down, the property taxes down as low as they can get them.
Yeah. And the cities, counties, they don't necessarily change the millage rate or the rate of tax, but they change the assessed value of our assets year over year. And that's really what we're appealing. We're not appealing the tax rate. We're appealing what the assumed value is from the city standpoint. So with that, we're going through, we're submitting income statements and all the CapEx work and market studies on what other people are getting to show has the value of this really risen. So on one hand, we're trying to say, hey, values haven't gone up. On the other hand, we're hopeful they do go up because it's more profitable that way. So, we're looking at it from both sides.
Right. And when we get those, and how we operate the business, when we get that new assessment, why don't we walk through kind of what happens at that point? So we just got these new assessments.
Yeah. So we appeal all of our property taxes. So across the board. So it doesn't even matter what the assessment comes back as. We use a group based out of Atlanta, and we appeal in every municipality we operate in to see, is there a way we can negotiate with them to lower our taxes? Is there a way we can lock them in for 3 or 4 years too? So there's lots of different things that could happen as an outcome from that appeal. But we're doing that every year on every asset.
Right. And then when from a P&L standpoint, we start basically accumulating cash to afford that full tax bill now.
Correct.
So make sure that we're.
Yeah. Our reserve strategy, if we get a new tax bill, we're basically dividing that by the 11 months, because they're doing November. They're not doing December. We want to make sure we have that money prior to the end of the year. So we're putting that in as our reserve goal, and we have to earn up to that money to be able to pay it. Some of them are due as early as the end of September. So the other part that's also impacted our financials, and this is really why we always need to drive revenue. We need to lead and get as much revenue as we can because of other expenses that go up. The insurance side of things. Insurance is also a November item. So that comes up with our annual renewal. And we have done everything on the insurance side, from different pools of properties, a master policy for everything, doing each individual property one at a time with insurance rates. We've done a lot of different things to try and manage what our exposure is and what our cost of insurance is. But no matter what we've done over the past 5 years, it continues to go up. We've seen some insurances, specifically like flood insurance. That flood insurance just has gone through the roof over the years. As expected, I think we've seen lots of.
There's only one provider of flood
There
insurance.
is only one provider. The government's underwriting all that, and they've been losing money for years on it. And then property insurance as well. This year, we had to go to dividing up our policies. We had 9 carriers that declined to enter the market and essentially say, they're not interested in doing multifamily insurance at this point in time. And because they couldn't get their head around the risk of it, not to say that they're going to open their underwriting information and share that with us, but it was more they're exiting the market or not quoting things in the market. To me, that would make it sound like either they weren't sure of what the risks were to be comfortable enough to put their money behind it. We saw some insurance rates that, that almost triple in certain areas. There's not really anything specific that we did to cause that. We don't have, huge risk on our assets. We don't have a lot of crime events. We don't have a lot of things happening. We're like, whoa, we're going to stay away from those. It's more just the market pricing of insurance right now. Also there's one side, as soon as you say, hey, insurance rates are more expensive, you're like, well, crime is going up. And I know there's been a lot of talk of that, but it's also values going up. When an apartment goes from 40,000 unit to 140,000 a unit, it's like now the insurance provider is underwriting $140,000 of unit of risk, not 40.
Right. And that happened with our Park Hill property that we lost 8 units for, what was that, 6-9 months ago, is that, we bought the property for roughly 20,000 a unit. We were into it for about 50,000 a unit. And if you rewind 5 years ago, replacing those units were probably $70,000, $80,000. And fast forward to today's dollars, and replacing the units were more like $120,000 a unit. And that's what insurance paid out when we had to tear that building down. So it cost them a lot more than they were initially underwrote.
I don't think, they didn't come out positive on that one.
Right.
So they, the insurance company there is like, we can't be paying out 120 if we're getting paid on 40 or 50 of value. So those two things coupled together creates uncertainty, and it creates rising prices in the insurance space. The only thing we can really do to combat that is we are out when we had over 25 quotes across our assets for this renewal period. We put a lot of time and effort into trying to figure out what's the best way to package and insure these to get us the most cost-effective strategy. And even with that, we saw some pretty dramatic increases. And I would say we're looking for that for the next 2 years as well, of that continuing. So revenues will have to outpace that to have a financially successful property.
Right.
And that's what we're working on. So we'll dive into some questions. I know we've got a couple that I saw just came through here. So we're going to bring Natalie in and go through anything that we want to go through.
Wonderful. Yes, lots of taxes and insurance questions for you guys. So first, how do we handle the property tax increases? Aren't those set when we purchase a deal?
Yeah, I mean, a little bit what Josh mentioned, like they're sort of set. Like when we're buying that deal, we know what the taxes were the year before. So we're saying, well, that's the number we're going to go with. And we assume that they will value the property at what we paid for it. But that's an assumption. They could value the property for whatever they think it is. A lot of times they just default to what we paid for it. And our appeal, if they're higher than that, we'll try and appeal and say like, whoa, we paid $8 million for this asset. It's not worth 10. We just bought it 2 months ago for $8 million. And therefore they may or may not listen to that. They don't, this isn't
Democracy.
Yeah, I don't know. They don't have to necessarily agree with our appeal or our valuation. And they could say, no, hey, sorry, we valued at 10 and your taxes are based on that. At that point, there's not much we can do from that standpoint.
You touched a bit on crime and its relationship to insurance rates, but have you seen higher crime that's been driving our insurance rates up?
So specific crimes that have driven our insurance rates up? No. The biggest thing that drives our insurance rates up or causes complexities for us is fires. Josh mentioned the Park Hill fire. That was a big one. Obviously, as soon as that fire happens, the insurance company pays out, and then they immediately decline to issue us insurance for that property. So they're basically out of our pool because we had a fire, we had a major loss with them, and they can no longer issue us insurance on that. We had another fire in the first quarter on one of our assets that affected 2 units. But that's a big deal. As soon as we have a fire, most likely they're not going to insure that going forward. So those are really the things that we see that cause changes in insurance rates, specifically with our properties. We have not seen dramatic increases in crime. And we have stuff I would say
Urban,
rural
yeah. Rural
to
and
suburban to urban across the board. And we have not seen any real dramatic increases in crime across our portfolio.
Our next question is on rising costs and income. So how will income outpace the rising costs of taxes and insurance and wages and materials?
How is a good point of, rental rates have to go up to cover those things. But I think, when you're looking at rising costs, the basis becomes really important that you have in a deal. Because the basis is really assessing how much equity you have in it and how much debt you have on the deal. And rising taxes and insurance isn't something that's, hey, they just decided to raise taxes and insurance on Greenleaf properties. Like, it's across the board, they're doing it. So all owners of assets are now facing these rising costs, and they will have to pass those through to residents. And a lot of that, I think, is why we've seen pretty dramatic increases in market rents. One, there's demand, but two, there's significant cost increases that have to be made up in the multifamily space, really in the residential space as a whole.
And as we talked about retention over the last decade, we've talked about retention, and to Dave's point earlier is we will have to see a decline in retention to capture those market rates. So we'll have to see more unit turnover and capture, those new revenue dollars.
Yeah. So how will it outpace it? It's going to be a shift on our end. It's a shift on how we address our renewals and go-to-market strategy with, not that we weren't before, but really pushing what's the max level that we can get rental rates at while still having a happy customer. And in the market as a whole, I think they're going to be doing the same thing, and you'll have a varying degree of how important is that customer happiness while you assess rental rates. I think it was like 3 years ago, the Occupy Wall Street, all about the rental rates. There has not been a lot of that lately. So it was more of an issue 3 years ago, and now we have significantly higher rental rates than 3 years ago.
Mhm.
Still on the topic of rising costs, how much more do you think costs will rise? And do you think it will force us to sell deals that we can't keep up with the costs?
I think definitely if we cannot keep up with costs, we've run into that on deals before, even prior to now, where costs became too high and we had to exit those deals. That Randolph, 214 Randolph was a deal we did in downtown Atlanta. And by the time we had finished everything, we did all the renovations, we refinanced it, we did pretty much everything we could do. I think our taxes at that point were like 3 months of income.
Right.
It's
Unmanageable.
Yeah, and those units were 650 square foot units that were one bedroom. So there's not, back then, if we would have known what we know now, right? It's always easier looking backwards, but it wasn't like, hey, we're gonna be able to double the rents on these things. That just seemed a little too risky for us. So when we sold that deal, we sold it to someone who bought it with all cash. They didn't even have debt, because 3 months of just taxes were 3 months of revenue. That was just too high for us, and we couldn't do that. Right now, we're not at that point on any of our deals, but if we get to a point where we start seeing 25% plus of revenues going directly to taxes and insurance, we start running into a rock and a hard place.
Yeah.
You're kind of
Affordability
stuck there.
issues.
Yeah, so that would cause it. But how much more are taxes, insurance, and just costs in general going to rise? Another big factor is utilities. I don't think it's a secret that most of our infrastructure needs some additional love. And with that comes higher, not like just rates for water consumption, but your standard bill rates for the service side of the water department, things like that. So I think those costs I don't think we're seeing a decline anytime soon. And with inflation, they're just going to keep going up. And if we're modeling those to be going up at a 10% rate a year, we need to make sure our revenue, if they're 20% of our costs, we got to make sure our revenue is going up at least to cover those things. And we make sure we can do that.
Now we have some sale questions for you. First, what happens with the cash held at the QOZ fund from the Heritage sale?
Yeah, so we had fresh equity and we had QOZ funds at Heritage. So the fresh equity part, their money was just sent directly back. We did not do a 1031 there. So they received cash back. The QOZ fund, that money, so the QOZ fund owned a portion of the Heritage Square deal. When Heritage Square sold, the proceeds went up to the QOZ fund. And that cash is currently just sitting at the QOZ fund in our reserve account. And we are opportunistically looking for a way to deploy that within the QOZ guidelines to earn extra money on the deal.
Right,
Or
and-
earn extra money at the QOZ fund level.
Right, and within the QOZ guidelines, we can invest 10% of the QOZ fund into non-QOZ assets. So based on the
Yeah.
cash remaining, there's roughly about 10% of cash remaining. So we can actually be somewhat creative on what we do with that cash. It doesn't have to necessarily be another QOZ deal.
But it can't just sit in cash. That's the
Correct.
other part. Like we can't just have that cash, have it sit there. That is against the QOZ guidelines because they want people to deploy that money and use it. But yeah, the 10%, it sounds confusing because we're saying the same number, right? But you can't hold 10% cash, but you can invest 10% into whatever you want to do. And hopefully, or not hopefully, but our goal is to increase the value within the QOZ fund itself. Overall, our pref return on the QOZ fund is 10%, and we have to hold it for 10 years, which is essentially we have to double our money that's in the QOZ fund. And that's the goal remaining between now and 2029.
Yeah.
We're going to be talking about QOZ fund all the way through 2029. And at that point, we can really, that's when you can liquidate initial equity from a QOZ fund. So we got a couple more years to go.
Yes.
Just a few.
Still on sales, for the Hillcrest sale, when will the final proceeds be distributed? And why does it take so much time to close out deals when they sell?
We really wish it could go faster. The closing out of deals is something that's always been challenging to do. The main part is the transition of the management from us to a new management company. We can do the physical property closing. We get a closing statement. It's like, bam, okay, it's done. So-and-so owns it. That's pretty straightforward. But with Hillcrest and a lot of the deals we do, we are taking a deal that we're doing a drop and swap with on the 1030. So we're always trying to guess prior to closing, about a week before closing, we're trying to guess what the exact closing numbers are going to be. I don't think we've ever been exactly right.
No.
I think it's probably impossible to be exactly right because you're talking about all the different prorations and everything that has to happen. But what happens is we have to guess how much money goes into the 1031. And we're normally pretty close, but we're never going to be exact.
They were usually under 1%.
Oh, yeah,
Yeah,
we're
within
very
that
close,
range,
but it's
yeah.
not exact. And then we also have an amount that we hold back to say, hey, what happens if any bills come in? We have bills that come in on a property when we sell it up to 9 months later. Sometimes we, even after we've distributed everything, we still take a hit on those because vendors will take forever. We try and tell as many people as we can and tell everyone, hey, we closed, send us everything. But that's not the reality of how it works. So the first struggle is balancing that 1031. We can't, if we get the numbers wrong, not that they're wrong, but like our guesses that are in them, there's always a true up with that. We can't do the true up until we close the next round of the 1031.
And that round of 10, specifically for Hillcrest or L17, those properties will close in mid-May. And so that's when that cash basically becomes available to basically true up any balances.
Yeah, because right now it's just all locked at the exchange agent.
Right.
So we have a little bit of time, and we're doing that 1031. I mean, there's a few instances, Heritage being one, where we do not do a 1031, but the vast majority of the time we are doing a 1031. We are doing these post 1031 closing true ups, and that's when we're dispersing cash. If we didn't do any of that, and we just said, hey, we're selling it, here's money back, it would be a lot faster.
Of course.
But when for Hillcrest, it really follows with Oak Hollow too. We're still wrapping up those 1031s so we can make the final distributions.
Our next question is on Oak Hollow. So along those same lines, why did Oak Hollow take so long to close out?
That's similar question, but Oak Hollow was even more complicated than Hillcrest. Hillcrest was a single deal that we put some money in the 1031 and some money in a PropCo entity, and we sent that money back. Whereas Oak Hollow already had a 1031. So when we went to sell Oak Hollow, we have 4 entities. We have the original 1031 that then some money went back as cash out of the 1031. Some 1031 rolled. We had the new fresh equity that some went back and some went into a new 1031. So we have two 1031 entities that we're then trying to close out and to do our final true ups and send the cash back to two different PropCo entities that invested in L050. So L050 was a portion of a 1031 exchange, which was 60% or so from Foxwood and 40% was fresh equity. So we took one entity and turned it into four, and trying to true up everything and balance it out is time consuming because we have to make sure all of the next round of L050 1031 exchanges close. So I think that's beginning of May that our last one of Ocala closes. So,
Yep.
But that's why, it's basically a giant circular reference on our true ups when we have these 1031s with four entities. If you imagine if one's overfunded by $100 here, it's like, well, that means the other one's got to get three, have to get 25 each. This one needs 25. It turns into a big circular reference on the formula standpoint. But
Almost there.
we're almost there on this, yes.
Couple more weeks.
Our last question for you is on refinances. Can you give us an update on any pending refis?
I think the main pending one we have right now is the Grove. We entered our lease up phase with the Grove right in the middle of 2020, a little right before that, and we took lower rental rates than we had pro forma by about 25%. So we have been working. So once we sign a lease, we got to wait 12 months. Hopefully.
No.
12 years would be crazy, but 12 months to get that renewal and then bring them to the current market rent. So we have been working on doing that at the Grove, but by signing those lower rates initially, it helped us on the cash flow front right away. But now that was a short-term decision. Typically short-term decisions only solve short-term problems. So we're now looking at how do we increase our revenues to the standpoint that we'll be able to get the best long-term loan we can. And we've kind of been holding out on the Grove. So like, let's try and get more revenue so we can get more from loan proceeds.
Yeah, and also looking at the kind of the time frame, mid 2020 was kind of a terrifying time in history on whether people wanted to live in high density, housing or not. And so I think we did a phenomenal job in the situation we were handed. But now we're working on turning it and improving it.
And the Grove is all townhomes.
Mhm.
So it is a good asset. We sold Hillcrest, or we did fantastic on that with over $100,000 a door. So we see good value in our townhome type products, but we do need to realize the revenue growth there so we can get the best loan. The Grove has another 12 months left, 11 months left.
Yeah, I think it's April next year. Yeah.
So we have a little bit of time, and we're certainly aware that rates are increasing, although they're still a lot lower than they were even a few years ago. We're not ignoring that. It's definitely something we're looking at. We would love to be able to refinance that thing immediately, but we still have to manage getting additional revenue so we can get the best loan there.
Yeah, and for any of those that like to track how interest rates are moving, if you look at the 10-year Treasury, which today is around 2.7, the interest rates that we're getting on these multifamily assets are about 230 basis points on top of the 10-year Treasury. So give or take 5% is where we would be looking at, rates right now. The good news is that Fannie and Freddie are offering lots of interest only period. So we'll be able to cash flow pretty well for probably 3 years with interest only period once we get to that point. But on today's numbers, with the movement in the 10-year Treasury, that the Treasury was around 1.5, and now it's closer to 2.7. That's kind of the difference in rate that we would see, now to 6 months ago.
We had one more question squeeze in for you. So any thoughts of acquiring more multifamily deals in the near future?
So we started to look at plenty to evaluate the market, to evaluate our current assets, to look at growing our residential portfolio. And we do like the asset class, and we would love to acquire more. The current state of the market is that it doesn't really matter what you pay for them. What brokers are selling is that if you continue the rental growth that we've seen the past 3 years, which has been double digits, if you project that going forward for the future 3 years, you'll eventually achieve a 5% yield. And that's what people are buying on. And so we see that multifamily has been a very good market for flipping, but not really a great market for cash flowing. And we are cash flow investors and looking for cash flow opportunities. And we haven't seen the opportunity to really buy, renovate, and get to a cash flow position. It's more buy, renovate, and sell to the next person with the dream. And and we would not be able to afford to hold. So that's the challenge that we've been in. What we're aspirational about is that that rising rates and rising costs could create a buying opportunity maybe later in the year. Has not trickled through the market yet. So we're not seeing any softening.
And I mean, there is the potential to see, in a great market for multifamily, potentially some distressed sales, because there's a lot of interest-only floater loans that were taken out, and as rates go up, they could be caught a little bit, because we know a lot of those loans that were taken out, those assets didn't cash flow. So as soon as people are stuck with assets that do not cash flow, there's only so long they're willing to figure things out before they're like, wait, we got to get rid of this thing. So there could be some opportunity with that. That's certainly what we're looking for. And another way that could be impacted is, with a lot of the people that we're buying from are individuals that own assets. And they get tired of seeing the tax increases. They get tired of seeing the insurance increases. And they're like, look, we got to unload this thing because these costs are too crazy for our appetite. So we could see some opportunities come in that place. We haven't seen any right now. We're kind of just forecasting that maybe we'll see some because of those things. But on one of these calls and one of these presentations, we're like, wow, we found a multifamily deal and we are excited. I'm just excited for when we get to say that we found one.
Right.
So we'll see, hopefully soon. We've been saying that for
A little bit.
2 years, 2.5 years now. So,
Well, those are all the questions we have. But again, thank you for joining us today, and we look forward to seeing you tomorrow.